So today I'm going to talk to you as Raoul Pal from Global Macro Investor, not Real Vision, because Real Vision doesn't have a view about markets and a view about economies, but I do have a view, and I've got a strong view that's been developing for a while now. As most of you know, I'm a student of the business cycle. I look at the ups and downs and the undulations of GDP, and you realise that things aren't linear, and most economists don't put some sort of cycle into their forecasts. Once I realised how cyclical things were, I realised there is an element of predictability. Now, obviously, sometimes with a cycle, things don't work out exactly as you imagine, the timing doesn't work. For example, I did think we were going to get a full recession in 2015. Didn't quite happen that way. We came very close. We had a manufacturing recession around the world. We had a few emerging market crises, but it didn't quite get to full recession, but it came incredibly close. But now we've got to a point where I've been monitoring how the cycle is developing, and I've come onto Real Vision a couple of times to talk about the bond trade, because I said, look, the cycle's turning, the best thing to do is be long bonds. And that's been a spectacular trade. So particularly in the short end of the Eurodollar market, and even in the long end, whether it's TLT or bond futures, there's been a huge amount of money to be made in that. But now we're getting to the point where the Fed look like they're about to start to ease. And we need to decide, okay, how far are they going to go? And are we going to go into recession? This is probably the only call that matters. And I've talked before, the only asset class that matters right now is the dollar, which is range bound. So it's currently not the predominant factor. Outside of that, it's trying to decide, is the world going to go into recession and is the US going to go into recession? My hypothesis is it looks like that is the case. Now, one of the things anybody who knows me knows that I don't talk in certainties. So I'm not saying, look, it's definitely a recession, we're all screwed, whatever it is. I don't even know how severe it can be, but what I'm interested in is the probabilities. And the probability that we are going into recession or are even in recession now are very high. So having realized this, I thought, I'm not the only person who thinks this, but there is a whole group of people who think the opposite. And it's one of those turning points where I feel insecure to know, am I right or not? I think I'm right. And I think, the people I advise, they think I'm right, but there's a whole group that doesn't. And I thought it would be really interesting to explore this theme fully on Real Vision, for me to essentially take over the platform for 2 weeks, to really dig in and interview all of the best people I can find in the world, people I really respect, people who don't have the same view as me, who may happen to have the same view or just different perspectives, to find out really what's going on. And it's going to help me and all of you go on a voyage of discovery to really figure out, are we going to recession or not? And then we'll try and figure out over the course of these 2 weeks as well, the opportunities and the trades that we can make to protect ourselves or to make money, whichever way this goes. So let's start at the beginning. The Fed started raising rates a while ago, back in 2016. And it was really incremental. And that incremental rate rise really didn't mean a lot to most people. We kind of brushed it off because rates were going from a very low level to another low level, but they kept going up. There were rate rises after rate rises after rate rises, but all very incremental and small. Then the Fed started QT, quantitative tightening. They started shrinking some of their balance sheet as well. And again, it didn't look a lot compared to how much the balance sheet had grown over the previous decade. But that had continued for a while, and nobody was that concerned about it. I started getting a different perspective from about August of last year, and it really came to the fore in September, October, November, and December, where I suddenly thought the Fed have over-tightened. And that nuance shift happens incredibly quickly because everybody at the time was saying the Fed aren't tightening enough and oh my God, the economy's heating up. And if you remember, everyone was arguing about labor inflation, wage inflation, the Fed are behind the curve. And from everything I looked at, the Fed had gone too far already and they'd pretty much baked a recession into the cake. So what was I looking at? The first thing I looked at is it's the rate of change of interest rates that counts. And I think I showed this on my last presentation on Real Vision back in, I think it was October last year. the rate of change of LIBOR, so that's just interest rates, they had gone up enough over a 2-year rate of change basis that it was the largest percentage increase in rates in all history. And again, many of us said, yeah, but the rates are so low, why does it matter? But the point being is, in fact, almost everybody refinanced at the lows. So everybody with a house, everybody with a business, every corporate balance sheet, every bank, everybody took out more debt at low rates. And debt exploded. So even my mortgage had gone up 40%. And I was a little bit shocked. I hadn't realised. And it was only one. I suddenly got the statement through. And I went, wow, 40%. And then I wrote about it in Global Macro Investor. And there was a large family office. And the principal of the family office called me up and said, we finance all of our debts for the family office, all the leverage that they use and all the other bits and pieces in their businesses and all of that stuff. He said, I refinanced in 2015. He said, it's gone up 80%. I'm like, wow. And how much leverage have you got? He said, well, reasonable, because money's been free, so we took a reasonable amount of leverage, but it's gone up and it's meaningful. So I started to think, they really have over-tightened. So if you look at this chart of the 2-year-on-2-year LIBOR, and I put it against the business cycle, so I use ECRI, you can see it suggests that the business cycle should fall significantly from here. Now, that's one thing. The other thing is the Fed is still tightening via the balance sheet. That's not stopped yet. We don't know whether it's in the July meeting, the September meeting. When are they going to stop doing that? But really, there's a mass tightening going on. And if you can see, that keeps going on month after month. There is another nuance about to hit us, and that is the debt ceiling. At some point, they're going to have to agree a new debt ceiling. It's most likely to be this summer, and that will also mean that the Treasury, who have been funding the government in the meantime, are going to start withdrawing the funding by issuing bonds. So there could be a huge tightening to come in the August, September, October time period of this year. So there's some further tightening to come, even if the Fed end up cutting interest rates. The other thing that most people don't realise is even with these ultra low rates, people have been really penalised. And if you talk about what upsets people about the kind of 1% and the 99%, one of the simple things where this shows up is credit cards. If you look at interest rates on credit cards, they're in fact at all-time highs, higher than they were when interest rates were much higher in the 90s, the early 90s, 2000s. It's extraordinary how much people are being penalised to borrow money, and that's at the household level, while at the corporate level, there's many corporates around the world, not yet in the US, who are borrowing at negative rates. And I'll come on to a whole lot about the corporates in a bit later in this whole thesis. So you can see we've got the setup where it feels like rates may have gone too far. And I'll come a lot more onto the rates market later in the yield curve and some of the signals there. But you see, what turns a slowdown, and we started to see the slowdown happening in December. We started volatility rising again in the equity markets, and we started to see the bond market rallying like crazy, the yield curve inverting super fast all across the curve. Is what then happened is what you normally need to turn what looks like something like 2015 into a much higher probability of being a recession is the extraneous event, and that was trade wars. See, trade wars are not what everybody thinks. There was a lot of noise about them, and at first, people weren't sure what Trump was going to do. But he first went after the Chinese, then he went after the Europeans, and then he's been going around after the Canadians and the Mexicans, and then he's done a deal with the Mexicans, and he's done a deal with the Canadians. But trade wars are happening, and China, the Chinese situation is very, very complicated. And with Europe too, we haven't got anywhere in the Europe negotiations yet. You see, the problem is his aggressive negotiating tactics have created a knock-on effect that most people don't understand. If you are a corporate and you have this game of cat and mouse with China and the US about not only normal trade, but also about technology and the banning of technology to stop technology spreading, there is a definite move within the US administration to really isolate China in numerous ways, but particularly economically. But don't forget, We've just come from the most globalised world we've probably ever had. So if we back up maybe 6 years, we're the epicenter of globalisation, and everybody has decided that China is the future. All the big corporations around the world, whether it's BMW or General Electric, have all moved to China. They're building factories, they're outsourcing, and they have supply chains. Suddenly, they're being told, well, you don't know whether those supply chains are going to stay. You don't know whether you can actually stay in China, or maybe even the Chinese end up booting you out. You don't know whether you can produce cars in Mexico or not. It's really confusing, because is Trump going to go back against what he's just done with the Mexicans? What happens with the Canadians? How does that work? Is there any labour arbitrage anymore in a world where he's even going after Vietnam, a country so small to be irrelevant, to stop the Chinese circumventing trade tariffs? He's also manipulating OPEC, and you don't really know where this world is. And you know, no doubt there'll be a time when he'll start picking on India as well. So he's picking on all of the countries in the world, and that's all well and good. And I've talked about this on Real Vision before, is a shift away from globalization is not the end of the world. It is the shift itself, the rate of change that matters. That rate of change is incredibly unsettling for corporate America, particularly, and the global corporations, the multinationals. Almost across every boardroom around the world right now as a conversation is, can we outlast Trump? And that's a bet. If we don't, we've got hell to pay with our shareholders. If something happens and we don't have an answer, we're in trouble. Well, okay, we'll build some inventory. So everybody's built inventory just to give them some sort of buffer. And now they need to make the decision, do we pull the plug now or do we wait? Wait and see whether Trump goes, wait and see whether there's any option. So those two outcomes are really interesting to me. Because if you pull the plug now, you break the global supply chains. That's happening everywhere. We've seen the announcement from Apple this week alone that they're doing it. The others decide, well, we'll wait and see. So what does that really mean? That means corporate expenditure stops. They tend to then spend a fortune on somebody like McKinsey or KPMG or somebody else who's going to give them the advice on building new global supply chains, bringing their business back to the US. It's a 2, 3 or 4 year project before they make the choice of where they're going to spend and rebuild their supply, their factories, and all of this stuff. So that generally means there's a big crimp on spending that comes from corporations, particularly in FDI. So that's going to hurt several countries around the world, particularly China, but there's a lot of countries and a lot of companies who are going to see this spending freeze and have to wait and sit it out. So that is going to have the effect of lowering growth, and I think that is what tipped this situation from merely a slowdown that was looking nasty into for me, an almost certain recession. So the question is where are we now? Many of you remember I used to use the ISM as my main way of looking at the business cycle. I don't use it much more anymore because it kind of got a bit broken, and the reason it got a bit broken was not because of Fed manipulation or anything else. It's because the oil sector became so large that the oil price became the largest influence of the ISM itself, particularly the refinery cycle every year. So I shifted away to the ECRI, and that's the Economic Cycles Research Institute measure, and it's a weekly indicator. And I use the year-on-year return of the weekly indicator to give me the business cycle. It works very much like the ISM, and it correlates with everything like GDP. So you see the chart here of ECRI with quarterly GDP, and you can see how well correlated it is. It's indicating that we've got some weakness to come. Okay, so that's the first interesting point. Then I like to put the ECRI against a number of other indicators that may be forward-looking. And this is where it gets interesting. I'm going to show you a whole series of charts now for you to look at. So this chart is the Cass Freight Shipments Index. You can see how dramatically freight shipments have fallen and how much they're suggesting that the ECRI could fall from here and therefore the GDP as well. Car loadings, a similar way of looking at transportation, it's collapsing. Capital goods orders, these are the big ticket items, the things that a lot of times you use financing for or are involved in the global supply chains. You can see how they are rolling over as well and following ECRI lower. If you believe in this supply chain story, and it seems to be bearing itself out in the press almost daily, then you've got to imagine that capital goods orders are going to come lower. But households are also struggling with the rates. So you've seen that in how much car sales have fallen. So car sales have languished and they're expected to go further. Clothing sales have collapsed in recent months as well, which has been an extraordinary move. And restaurant sales as well have been extremely weak. So you're starting to see not only is shipping and moving goods around weak, but you're also seeing a weakness in the consumer and a weakness in business expenditure. Another great global indicator I've looked at is semiconductor sales. Semiconductor sales are extraordinarily weak right now, and they too are suggesting the global business cycle has a lot further to fall. Back in the US, we've also got the housing cycle. It looks like that the Case-Shiller House Index is starting to weaken significantly and is now at the weakest level since before the previous recession. And we also have weakness in house prices overall and construction. So I'm concerned that all parts of the economy are showing evidence of weakness. And I know many people say, well, unemployment's not. Unemployment's strong. Unemployment, interestingly enough, is the most lagging of all indicators. And just remember that every time the Fed cut rates and unemployment was below 4%, we went to a recession almost immediately afterwards. They're all lagging. So don't get trapped in the unemployment. Look at the forward-looking indicators, and they're looking problematic. So those are just some of the US indicators that I'm finding concerning. There is a general theme of weakness that lies ahead. And if you go back to that first chart I showed you of the 2-year on 2-year rate of change of LIBOR, of interest rates, then you're going to expect to see equity come down further and all of these things that are correlated come down further. Also, don't forget, the equity correlates perfectly to asset prices. If you look at the year-on-year S&P, it basically is the business cycle. Now, I understand that equity prices is part of the equity calculation, but I can use hard data and a bunch of other variations of the business cycle, and they all show the same thing. The equity market is cyclical. Right now, just because of the construction of what it was doing last year, it's at all-time highs. It should actually significantly weaken in October, November if the equity stays where it is. The other thing to bear in mind is there looks like there is a marginal pause in the data, and you'll see that in the global data in a second. So that's one of the things I'm waiting for over the summer, is let's wait and see how this plays out and whether we get some weakness further on again, which is my expectation, but it's really what I want to pick people's minds about. When I look at the world PMI, you can see the world PMI is just heading into recession territory. So it's weak. It's telling us that there is a definite susceptibility to anything else going wrong. And I'll come to some of the banana skins later, but anything going wrong is going to turn this from a slowdown into something much uglier. I think the Trump trade situation is that very thing. We're starting to see many central banks around the world expressing concern and thinking about cutting rates in response to this kind of very weak economy that's starting to develop. The other thing is the trade tariffs are showing up in the data when we look at world trade volumes. World trade volumes are starting to come off sharply, and I think that's really important. We also have a GMI indicator for world trade, and it is also coming off very dramatically. So it's something we need to be very careful of to see how this develops. And again, the one thing, and I'll talk about it later, that we really need to be worried about is if the dollar goes higher than here. Another concern for me is the European economy. The European economy was really led by Germany, which is different. This time around, it's not the peripheral European economies, it was Germany that started first. Firstly, a relatively strong euro, and secondly, trade disputes. So trade issues. Those two things suddenly started to mark a turn in Germany. And Germany has gone pretty much to recession. GDP is not negative yet, but all of the forward-looking indicators are showing that Germany is going towards recession. If you look at, for example, industrial production, or if we look at exports, we can see that there's some concerning signs in Germany. And if we look at the ZOO survey, which is their forward-looking PMI, it's suggestive that GDP is going to go negative 2%. That's quite a big move for one of the largest economies in the world and the largest economy in Europe. But you see, it's not just at Germany level. We've got Italy that is actually in recession again, a mild recession right now. And we have France that is starting to weaken and is only just growing. So we've got the three largest economies in Europe not in great shape. Spain is the only one that looks okay right now. When we get to Portugal again, it's getting weak. And Holland doesn't look great. So Europe is looking a bit of a mixed bag, and we'll come back to Europe later because it's one of the weak points, and I think it's one of the places that we all need to understand. In this globalized slowdown, we can also get a bit granular with China. China struggled from a load of monetary tightening a couple of years ago, and the government trying to rein in the speculative excess of a cheap money boom that came out of the back end of the global recession. So China's been tight, and it kind of broke. The financial system doesn't function properly in China any longer, and the government is involved frequently trying to keep some sort of liquidity. They're not interested in bailing out the rest of the world by another liquidity event. It's just not in China's interest. They just don't have the ability to do so. And why should they? Why should they when the rest of the world is being so antagonistic? So the point being is China's very domestically focused. They're trying to unwind their bubble. They're trying to stimulate enough just to flatten it out, trying the Japan way of doing things. But that means that China, which was the marginal rate of change of growth of the global economy, they're just not players right now. They are negative in terms of imports for most of the raw materials. So they're not going to be driving other countries' GDP growth. And I think that's a really important matter. We've talked about the US, there's no real growth there. We've talked about China, there's no real growth there. And we've talked about Europe, and there's no real growth there. So where is the growth engine? There isn't one. And then when you broaden out to the rest of Southeast Asia, you can see that South Korea is also starting to slow down. Exports there are weak, and the same in Taiwan, and we can assume the same is across Asia overall. Australia, far too small an economy to matter in the globalized context, but as we know, Australia, and as we feature on Real Vision, has a problem with its own domestic economy, with its massive house price boom and the overhang from the mining boom as well. So the Australians are cutting rates, they've got a slowdown going on, they're trying to manage it the best they can without it turning too ugly and without it turning and rotting the banks at the core. We have to wait how that plays out, but again, it just tells you the number of countries who are in a similar situation. And the same can be true and said of Canada too, which is one of the larger countries in the world, but again, they've had some problems. They've got the back end of a commodity boom, plus they've got an excessive leverage in the housing industry, and that all needs to unwind, and they too are going to be cutting rates. So I don't see a situation where anybody can save this. And we've got, I think, the tipping point with tariffs that overrides all of this. So this is why I'm really starting to get concerned. But you see, I may be picking this up, but the bond market's always smarter than everybody. And I'm always incredibly amazed how right the bond market gets these things. Everybody argued when the yield curve was flattening, the bond market's wrong, it's just the Fed. Everyone says it doesn't mean anything. The yield curve, it's just a different world right now. The yield curve started flattening, then they started inverting, and they started inverting all the way across the curve. We got the 2-10s US swaps curve, which is the main one. Every time it gets to zero, we go to recession shortly after. We've hit that. We had the 1s-2s curve going to the second most inverted in history. So that means 2-year rates were trading below 1-year rates, suggesting that the easing that was necessary was large. They were screaming the Fed had gone too far. And then we had 2-year rates versus Fed funds. The magnitude, I think 75 basis points or so, the magnitude of that was also extraordinary and was telling you the Fed had gone too far and things had to change quickly. The Fed suddenly started realizing this. By December, January, February, they started changing their tune. Now we are here with the market saying, well, we had a good employment data. The Fed, no, they'll cut 25 or not at all. They don't need to do this. It's ridiculous. These bond market indicators have never been at these levels without the Fed cutting 50 basis points immediately and 50 again soon after. So my core view is if this continues in any way, unless we see some sort of trough in the very near future in the forward-looking data, then the Fed are going to cut 50 and 50 again. I don't see the point of the Fed trying to cut 25 and disappointing the bond market. I think they have to play a very, very careful game here, and what they need to do is at least try to be in front of the curve. That 2-year anterior rate of change tells you they can't be ahead of the curve. The curve's well ahead of them. But the market needs some sort of perception. But I do think there's a backup coming in the bond market. We'll talk about this in a bit as people are trying to readjust the probabilities to do 0, do they do 25, do they do 50? Are they going to completely reverse? Is this a bond meltdown coming? You know, I see all of this noise on Twitter all day, and we'll address some of that in a bit. See, the other thing the Fed have got is the Fed have got a problem because they're still tightening the balance sheet, as I talked before. But when they look at what they're trying to do, they have that dual mandate. The dual mandate's employment. Well, employment looks fine right now, and it always does at the peak of the cycle. And they always cut when unemployment is almost at the all-time lows. But the key is inflation expectations. They're collapsing all across the world. But if you look at the 10-year break-even rate, it's broken this big head and shoulders pattern, and it looks like we're going down to 1% or so. That's enough to be a 50% miss on the 2% implicit target the Fed's got on inflation, and this is 10 years out. So it's telling you that the rates are so tight because there's so much leverage within the economy that they can't raise rates without collapsing future inflation expectations and future demand. So I think that's a really important indicator. We can also see the 5-year on 5-year inflation expectations. That, again, is breaking towards all-time lows. There is a complete collapse in inflation expectations, regardless of the narrative that we heard only up until November, December of wage inflation. It's all going to come back. That was if you remember, my premise for the bond market rally was that narrative was wrong. That appears to be playing out, but not only does it appear to be playing out, it appears to be going from benign to nasty. So I think it's something we need to watch. But inflation is not just collapsing in the US, it's collapsing around the world. So the rest of the world is also seeing an inflationary, deflationary or disinflationary issue. I think the most extreme is Europe. If we look at the 5-year break-evens in Europe, we see this enormous collapse in inflation expectations. And that's with an economy with negative interest rates. I mean, what the hell do you do about that? Europe is going to become a big issue. And again, something I'll come on to in a second. But that is a real warning of how do you generate inflation in a world straddled by debt? It becomes really complex. And how do you stop the downside becoming a much larger event than it ordinarily would be? When I look at these kind of theses, I like to cross-check against asset classes. I would like to look across the world and see, okay, how are asset classes trading? And the first one I look at is copper. I look at the chart of copper and it's a clear head and shoulders top. And to me, that's telling me that the economy is slowing down. What's also interesting, if I put the copper chart against the 10-year break-even, you can see it's the same chart. So copper basically is a real-time example of future inflation expectations, and they look like they're going to break down together. If I look at the CRB Industrial Metals Index, you can see that this big uptrend and this major topping pattern, a huge topping pattern is forming, and I think that it's likely to break that. And why I think it's likely to break is I think it's probably the second ugliest chart pattern in the world, which is the CRB Commodities Index. If you look at this chart, it looks like we're going to go into a secular bust in commodities, due any day now and to last into the next few years as we reach for that final bottom. And I think that bottom could be uglier than many of us are expecting. A, because of the size of the boom that we had, the amount of capital that flowed into it, and particularly in the oil space and some of the mining space as well, and also because what I think is going to happen to the dollar. So these charts are really ugly charts to me, and it makes me very concerned that there is a broader disinflationary or deflationary world out there that's developing. And it's something I talked about in the last video I did for Real Vision that subsequently now developed further. So let's talk a bit about the risks. So I think I've established a case why it looks like there's a possible recession coming. My probabilities are higher. They may be higher than yours. You may think I'm wrong. That's okay, but you have to understand that the likelihood of something happening here is reasonable. So you're going to have to factor this into your investments or your working lives or all of the things that a recession can affect. And I think that's really important, your businesses too. So let's think about the risk. Now, one of the risks is China. I don't think an implosion of the Chinese economy is much of a risk because the US are basically forcing everybody out of China anyway, so it's happening in slow motion. We're also finding there's a trade ban going on with many other issues with China, so that's not great. The Chinese themselves are going to be propping up their economy. They're trying to stop their banking system falling over. Okay, so that's relatively stable because it's a closed system. They're going to have some inflows from MSCI, and that was the inclusion of China, both debt and equities in the indices, although I think the US are going to try and overturn that by putting political pressure on MSCI themselves. We'll wait and see about that, but I know it's a way for China to get capital. And that's what China needs. It's dollar starved. And the US knows it. So if China's dollar starved, well, the best weapon you've got is the dollar. And if you look at the chart of the Chinese RMB, it has been pressing its nose against that 7 ceiling for a while, forming what is one of the largest cup and handle formations I've ever seen. If that does go and 7 breaks, then we're going to see an almighty move in the dollar against the RMB. Now, it doesn't necessarily mean there's a catastrophic devaluation coming out of China, but a shift in the terms of trade, which has massive global ramifications and will obviously knock on all the way through. And I think you can see also, if I look at the ADXY, which is the Asian currency index, if I look at the big monthly chart, there's an enormous head and shoulders top that's looking to break. This is the largest chart pattern I've ever seen in any currency market, but that is a incredible chart pattern that tells me there's a potential currency crisis in the making, and it's to do with the strong dollar. The other one that's affected by the strong dollar and the weakness in global trade, and particularly interest rates, is Europe. So the European banks, something I've talked about extensively for many years on Real Vision, as the European banks have gone lower and lower and lower, and I said there's a big problem here. And I know many bank analysts will say, well, there's not a solvency problem here, it's different, they've got the right capital resources. Well, I look at the share price. I just look at the share price, and it looks like the share prices want to go to zero. So the worst chart in the world, I label it the GMI worst chart in the world, is the European Banks Index chart. It is a truly terrifying chart, because this is all of the banks in Europe, and it looks like if they break that key support, then we're going into a full banking crisis in Europe. And I think that's a reasonable probability, and here's why. You see, the European banks are international in nature. Deutsche Bank, even the Swiss banks, Credit Suisse, UBS, Société Générale in France, Santander, BBVA, all of these banks are international funded banks. Yes, they get their funding and their collateral with the ECB, but the reality is the day-to-day funding is the euro-dollar market, and they don't get access to all the capital they need. There's a shortage of dollars out there, which is a problem. I think the dollar goes higher, which creates a problem for these banks. If you look at that European Banks Index and look at it compared to the 10-year Bund yield, you can see they're highly correlated. So as Bund yields go down, the banks go down. But you see the problem here is the ECB has one mandate alone. They've got the mandate of inflation. And we showed you before the inflation expectations in Europe are collapsing. So it's a one-trick pony. The ECB can only do one thing, cut rates. I talked to the ECB recently at a Goldman Sachs event that I was hosting in London. And I asked them, okay, what are you going to do? What are you going to do when the next recession comes? And they're like, well, we can cut rates a bit more and we can do a bit more QE. But you can see there's a general understanding that they can't go that much further. And that's a problem for the banks, because how do you stimulate? So the banks are falling because these yields are really bad. Negative yields are bad for banks. The flattening yield curve's not good for banks. The whole situation is a bad setup for the banking system. And the Europeans can only deal with it by cutting rates, which is bad for the banks. So you've created a bit of a doom loop there. So it's a bit of a cycle that's not good. So the question is how do you stop it? And my idea is Christine Lagarde was brought in specifically for this. Why would you want her as a central banker? Why would you want her as the head of the ECB? The ECB was a very technical bank. It was always very good with technical monetary policy because it was very policy driven. It was less kind of broad-based macro-driven than the Fed. It was, really in the weeds. But Lagarde is not that. She is the head of the IMF. She's a politician, and she's a lawyer. And what does she do? She negotiates. And if you put somebody like that in control of the ECB, it tells you that there is going to be a shift from in the ECB, which is moving towards probably negotiation for this banking settlement. Somewhere everybody has to get together and do something. It's not just Germany here. It's not just Deutsche Bank that's the poisonous one. There's not one poisonous apple here. It's a whole system that's in a mess. There's still too much debt in that European banking system that's not been written off properly. So these banks are probably going to have to go in the hands of the governments. They're going to probably have to wipe out the equity holders somehow, and the bond holders will become the government. So that's the way you stop a systemic crisis, but somebody's going to have to pay for all of that, and that's going to be a ton of issuance of debt. So somebody has to negotiate new treaties to allow all these companies to exceed their deficits and to increase their funding, and the ECB to buy more of this funding, and there's a whole load of stuff that needs to get done that's much more political and legal than it is monetary policy. So I think that's why Lagarde is there. If you want somebody for the next recession, clearly the person who ran the IMF that deals in bailouts is the right person. So I get that, and I think it makes sense. But Europe, that's a tricky mess. This is not a quick fix overnight, and it makes me concerned that this can go from not very good to very ugly very quickly. And I have a feeling if I look at the share price of the banks, that by the end of the summer, we could be there already, where we're starting to see some of the real strains, and whether Deutsche Bank ever gets to its full restructuring before they have to do something about it. My guess is hearing the story of Renaissance Capital pulling its prime broking lines from Deutsche Bank means that we're potentially in the death spiral where it goes from not being a solvency problem to potentially being a solvency problem. Who knows? Wait and see. You know, getting in the weeds of the banks is not my thing, but looking at the macro setup, I can see that this is a problem waiting to happen or is happening right now. The other thing I think is further to develop is the tech market. I think there is a complete euphoria that has taken place in the private sector, particularly within the private investment sphere. So it's private equity and VC. I think too much money has been allocated without thought of getting the money back. And I think no better example than the poster child of SoftBank and how they put $100 billion to work plus added leverage in and just basically completely rewrote the rules of valuation of any firm out there with no clear sight of how to get out of it. I think there's some huge problems with what he is signaling, Masayoshi-san is signaling by trying to IPO the whole of the Vision Fund to start another fund. If you're trying to IPO kind of a VC fund on this scale, without actually the companies themselves going public, it's telling you he doesn't think the future IPO value is the same as the current private value. And we've seen that with some of the recent tech issues. They traded higher as private companies than they did as public companies. There is a different dichotomy between this, and that's telling me that things got too effervescent in the private sector and it's starting to come off, and it will knock on through as people realize that the future of tech is not quite as bright as people thought it was, and that there are some really systemic problems because of the over-ownership of this sector and the expected returns that's embedded within it. I'm really worried about SoftBank, and I'm really worried about what it says for the world. So we'll wait and see how that develops, but I think there's a tech problem. I also think, as I've mentioned many times before, I think there's a tech problem coming. As I mentioned before, there's a problem coming with Google and Facebook and their battle with the DOJ and various other parts of the US government. I think they're going to be treated as monopolies. I think they're going to have shown to have abused their monopolistic power. I think they are also using data in ways that people don't want, and I think their power is going to be curtailed and they'll be broken up in various ways. So I think that's coming, and I think it will come over or through this next recession. So there is another delta on the bad news, something that can drive it a little bit further that worries me, and I'm monitoring all of these themes as they all kind of come together, and it makes me worried. But there's two really big ones left that I haven't yet talked about on Real Vision. Some of you will have read it in Global Macro Investor, for those of you who are subscribers. And then recently, I published, much later than I published in Global Macro Investor, I published it in Macro Insiders and in Think Tank, my doom loop article. And if any of you are interested in this piece, I think you should all go back and have a look at that article. If you're not subscribers, sign up for a free trial and go and have a look through this article. And this goes through all of what I'm talking about in great length. I think there is something really interesting. In Macro Insiders, Julian Brigden and myself debated at length about what this really means and whether a recession is coming, and I think we'll probably show that later on this week as well, because something from Macro Insiders I think will really add value to you, much like this doom loop article. But the issue is corporate debt, and this is when it gets really big. So bear with me and maybe get a stiff drink while I sit down and talk to you about the doom loop. You see, every recession needs a poster child. There's always one. There's always the thing you pin it on. Back in 1990, it's a savings and loan crisis. Back in 2000, it was the tech wreck. And then back in 2008, it was the housing market. And this time, I think there's an even bigger and more concerning one. I think it's the corporate debt sector. I think this is the poster child of the next recession. Let me explain why. Firstly, you've got to realise that debt is basically a function of the business cycle. And you have, in most cycles, you have a super cycle and you have the normal cycle. So the normal credit cycle is very clear. If I look at the ECRI against the, let's say, the HYG ETF, you can see how highly correlated they are. And also, if you look at the ECRI versus Moody's BAA to AAA credit spreads, you can see it's basically a function of the business cycle. So the business cycle drives credit spreads, and it drives the availability of credit, and it drives the excess use of credit, and all of the issues that come along with it. And obviously, the Fed drive the credit cycle by raising interest rates or lowering interest rates. Also, the behavior of credit availability, which is the credit managers and how they give out credit, again, is really cyclical. So we can look at the index against the ECRI, and we can figure out that if ECRI, the business cycle, turns, then we're going to see some problems emerging in all of the debt market. Now, here's an interesting chart for you. Talking about recession, I find it hilarious that the New York Fed publishes a recession probability index. The recession probability index is in the 30s now, 30% chance of recession. It's ridiculous because if you look back at every single time it's ever been at this level, it's been a recession. So when it gets to about 20-something, it's 100% chance of recession. So the Fed, New York Fed, is basically telling you we're going into recession. So if we're going into recession, which is my core hypothesis, then we're going to see credit spreads widening. Ordinarily, that's not a big problem, because that's what happens. And we had it in 2008, and corporate spreads widened out and they narrowed. Yes, the banks, that was a whole different issue, the bank debt and household debt. We've had that as well. But this time around, it's somewhat different. See, this time, since that previous recession, the size of the global corporate debt market has exploded, and in particular in the US. US corporate debt as a percentage of GDP is the highest in all recorded history. By using the Fed data, we get about 47% of GDP in debt. But if I use other data, particularly from the IMF, we're getting numbers of about 75%. The Fed data doesn't take into account off-balance sheet. So if it's off-balance sheet derivatives and all the other debts that's on corporate balance sheets, which we know are all over the place, then we get to about 76% of GDP in debt. That's a really, really high number. So in nominal terms, debt is now $10 trillion. And it's just gone up in a straight line, as I said, doubling in size since the last recession. I mean, it's an extraordinary amount of debt. Don't forget, this is the same time the households have been gently easing out of debt. The financial system has been easing out of debt. And the government has not. But the government's been kind of relatively flat. But the corporate sector went on a massive debt orgy. It was one of the largest increases of debt we've ever seen in history in 10 years. A truly monumental debt buildup. What do they do with this debt? Well, this debt has been basically used for one thing. That's equity buybacks. They bought back more equity than any other time in history. In fact, they've been pretty much the only buyer of the equity market. If we look at all forms of other equity market ownership, they've been all in decline for the last 5 years, while buybacks have been stepping up, taking into account all of the net sellers and pushing the market higher. And there's less liquidity around because you're taking more shares out of the market by buying them back. So the less liquidity, the more your shares go up. And then when you add in passive indexation, it's been pushing the markets higher from this enormous debt issuance. That's all well and good. But once you start flooding the market with debt, you create a dynamic which is little understood. And that's the lowering of overall credit quality of the entire market. And this is not a US phenomenon, this is a global phenomenon. But in the US, now, over 50% of the entire bond market is triple B. Triple B is essentially one large notch above junk bonds. It used to be a world where there was a lot of AAA credit, AA credit. They're all falling by the wayside. What you're getting is everybody taking so much debt that they're becoming triple B. And all of the main bulk of American large cap firms are now triple B debt. And then beneath that, you've got $1 trillion. So you've got $4 trillion of triple B, and you've got $1 trillion of junk. That junk alone is the largest the junk bond market's ever been. But the real growth in this whole thing has been the triple B sector. You can see from this chart that if we put all the different types of bonds in a nice stack next to each other, the size of the triple B market is absolutely enormous. And when you break down the US triple B debt market, you can also see it's pretty lumpy. There are 5 large behemoths that account for $770 billion of debt. And if you add in the US shale industry, you're talking about $1 trillion of debt. Those companies are General Electric, General Motors, AT&T, Ford, and Dell. They account for everything here. It's huge. Obviously, there's a massive tier of corporations behind it that are triple B, but really, the risk comes down to 5 big firms. Just to understand how leveraged these companies are, here's the chart of debt to equity. General Electric is over 200% debt to equity, General Motors 250, AT&T about 100%, Ford about 450%, and Dell about 125%. AT&T is the largest, the most indebted company the world has ever seen. It is $170 billion in debt, and it is over 100% of market cap in debt. That dynamic can change dramatically if the share price falls. It's digested an enormous acquisition in Time Warner. And if you remember, AOL Time Warner was ringing the bell at the top of the last cycle. It kind of feels like AT&T Time Warner may be ringing the bell for this cycle too. And it was a debt orgy that allowed to do it because AT&T thought, fine, you know, we're a phone company, we get plenty of cash. The problem is corporate cash flow is correlated to the business cycle. If you look at the ECRI and look at S&P cash flow, you see they're highly correlated. So what looks affordable acquisition now suddenly becomes unaffordable later. If that starts to happen, then you've got a problem. And you've got a problem because, look, AT&T is not going bust. Well, at least I don't think so. But it's going to get downgraded to junk. There is no way on earth the junk bond market can take a downgrade like AT&T. Realistically, if you start to get in a recession, you should see, I don't know, 10, 20% of these triple Bs get downgraded. So we're talking huge numbers that have to get absorbed into that junk space. But there's only $1 trillion there, and the buyers are different. And this is a crucial thing here. The buyers of junk bonds are not the same buyers as the buyers of investment grade credit. Those buyers of investment grade credit will have to sell if it gets downgraded. So that means that there is a huge amount of selling, but the people in the junk bond market don't have 30% more, 40% more cash suddenly to buy this stuff. So the only way of doing it is by obliterating the junk bond market. So if these get downgraded in any way, shape or form, you're going to find the junk bond market becomes completely insolvent. But what's worse here is if you look at the debt that's coming up, it's a complete wall of the stuff that needs to be renewed over what looks like it's going to be the next recession. That's going to be a huge problem to try and roll all this financing that all comes due at the same time when the banks aren't going to be particularly keen on letting this financing out. And the companies are going to be desperate to get it, but their cash flows are going to be going down, so the affordability becomes a little more problematic even with rates being cut. This is why the Fed need to cut rates and need to cut rates fast, because this corporate thing is an avalanche waiting to happen, and the butterfly has flapped its wings and the avalanche is starting to crumble. But you see, this issue is not just the US, as I mentioned a couple of times, it's global. When we look at the global corporate debt to GDP, we're at 95%. This is the same kind of la-la land levels that we had on household debt back in 2008. That is an extraordinary amount of corporate debt. And the worst thing about it, almost all of it is in US dollars. Globally, it's in US dollars, except in Europe, and that's all trading at negative yields now, because it's European debt that can be used as collateral that has a huge value for the system that's slightly insolvent. So we've got a huge problem, because if you think about that, it's globalized, and it's in dollar funding, and there's not enough dollars around. Certainly not to roll all of this debt, particularly if the banking system in Europe is going to desperately be sucking for these dollars. We've got a big funding issue to come. And again, if the dollar starts going higher, it becomes a much bigger problem for all of these corporates to deal with, and a big, big problem for the junk bond market to deal with overall, and the investment grade market. See, I'm not the only one talking about this. Stan Druckenmiller's been talking about it. There's a number of people who've talked about it. And the BIS and the IMF have both warned about it, much like they did ahead of the 2008 recession. They're saying there's a huge problem with corporate indebtedness. There's a huge problem with the buybacks. There's a huge problem with the dynamics that it's creating. And this is the thing. It's the knock-on effects that I'm really worried about in this whole equation. A credit event, okay. A secular credit event, really nasty. But with a couple of other things thrown in, like a retirement crisis, then we've got something really, really concerning that we have to avoid. The Fed have to be really aggressive in this, or we've got a much bigger problem than we realised. You see, the bond market is supporting the equity market, as I talked about before. It's all the buybacks. So here's the graph of the buybacks that I talked about before. They're basically supporting the whole market. So if the corporate bond market gets a little bit tighter and cash flows go, all of the corporates are going to stop buying equity. The largest buyer will have left the room very quickly. So let's go through the causation here. Equity widens. It starts falling south for all the reasons I've talked about. It starts widening out the spreads. As soon as the spread starts widening out, corporate cash flows start going with equity, and corporates start going, okay, I need to be careful here. So what they do is they stop buying back shares. So that's the largest equity market buyer who's left the room. So that's a really big deal. So let's go back to the equity chart with the year-on-year S&P. If the equity falls and this credit cycle falls, then the S&P is going to fall with it in the year-on-year terms and also in outright terms. So we're setting ourselves up for something that could be quite interesting. Now, we know that consumer confidence is pretty much tied to the equity market right now. And so if the equity market starts falling because the buybacks have gone, then it's going to build on itself. And then it's going to build itself in a way that's going to bring out the baby boomers. And I'll come on to that in a sec. So there's another issue here. We had a guest on Real Vision who talked about the corporate bond market and the pension system. You see, I've talked about the pension system a lot, and I'll come on to that in a sec again. But the pension system has been a buyer of equity, but increasing buyer of corporate bonds because there's been some yield there, and also as you get an aging population and people are getting closer to retirement, you need more bonds, but they need to take as much risk as possible. So they bought a ton of junk and a ton of this triple B stuff. So they've been the big buyers. Now, what's been really interesting is they've been in a loop like the buyback loop, which has been driven by tax receipts. You see, places like Illinois, who have bankrupt pension systems, have been raising taxes, and with that tax receipts, they have been then putting it into the pension system to fill the gap. The pension funds have been buying bonds. So you've got this cycle with tax receipts coming in and you're buying bonds. You just create this loop. The problem is tax receipts are also cyclical. So once that happens and the tax receipts start falling because level of business activity is falling, well then guess what? The corporate debt buyer goes away too. So you're creating a market where there's no equity buyer and no corporate debt buyer because of how the pension funds operate. That's a real problem. And then if anything gets downgraded to junk, who's the buyer of that junk? That doesn't really exist either. You can see the chart here of US state and local current tax receipts year on year, and it's basically the same as the business cycle, no surprise. And it's gone negative as tax receipts have been lower than expected recently. And again, that should start pushing the credit spreads wider. And that brings us back to the baby boomers. These are the guys who all these assets are, the equity investments and the bond investments. They're the owner of all of this stuff, and they need to sell them too. And they need to sell them because they're going to retirement, and if there is a risk in the system, they cannot take the risk of losing their money because that is their pile that they retire with. And I talked about this at length in the retirement crisis video. So the chances are there's a behavioral adjustment of which they become net sellers into rallies and sellers into dips as opposed to buyers into dips. And that's because they don't have work or the amount of work needed or income needed to sustain an investment portfolio. It's more about living expenditure. And those that retire, they don't have more money to put back into the market. That is their pool. They're done. So they need to reduce risk fast. So when you've got a situation where everybody is a net seller, you've got a problem. That happened in Europe and it happened in Japan. We've seen what it does. It basically lowers for decades the price of equities and changes the structure of markets for a long period of time. And I think that is one of the potential outcomes. Again, I'm not saying it's necessarily going to happen, but there's a potential outcome here. So you're starting to see the various knock-on effects. I'll put them on the screen here and then I'm going to go through them a bit again later because there is a lot of points to get across. So as the triple B credits get downgraded to junk and the debt markets freeze, pensions will be forced sellers and take enormous losses and will switch to treasuries at 1% yields or less. This will essentially bankrupt the defined benefit pension system. It has to default on its promises. When you throw in the net divesting of assets that the baby boomers will do in the next recession, you have the perfect storm. There will be no buyers of equity. There'll be no buyers of debt. Corporations will not be able to service the debts or roll them. The pension system will break. Then throw in the EU banking system, which is fragile and needs dollars, and the entire bloody system will freeze all over again. This is what I call the doom loop. And it's small incremental steps that create something quite quick. Can the Fed get in the way of it? Can they stop this doom loop? Because there is a cycle here, because the moment you start widening credit spreads, you start creating selling, you start creating less buybacks, the equity market falls. If the equity market falls, then AT&T share price falls. Then they start pricing default risk or downgrade risk into AT&T. And then what you know is the junk bond spreads widen. The whole thing works in this endless cycle. So let me go through the points of the cycle again as well, just to clarify. Phase 1, the business cycle weakens. Credit begins to widen. Corporate cash flow worsens a tad, and shares fall and volatility increases. I think that's where we've got to now. I think phase 1, we accomplished, and it started really in about October. Phase 2, the business cycle weakens again. Credit widens more, cash flow gets worse, as do profits. Tax receipts fall, and state pension funds stop buying debt. Big BBB stocks fall, and bonds fall even more sharply. Equities fall hard. So I think this is the next phase, and I think it's coming after the summer. We'll wait and see. My forward-looking indicators suggest that Europe has a SESI upcycle right now. There's a bit of stabilization of data. I have a feeling that if I'm right about the debt ceiling or the dollar breaks higher, then I think we're going to start to see phase 2 come in. When we start seeing phase 2, we know where this is going, because then the story becomes very clear. Phase 1 was the alarm bells. Phase 2 is strap yourselves in. Okay, let's go on to phase 3. This is when things get ugly. The baby boomers start to panic to get out of equities permanently. There's downgrades of BBB to junk. The EU banks can't take the funding stress, and the ECB and the government step in. Credit spreads explode. Credit seizes up entirely as pension funds are forced sellers on downgrades. Equities go into tailspin, there are no natural buyers. Credit widens dramatically, offered only, no bids. Junk bond market overwhelmed. Pension funds get into trouble, defaulting on obligations. Big, famous companies are being forced towards bankruptcy unnecessarily. That's the really ugly phase. And that's the one where I think many of us have got a sense that there is an end game that's at the end of all of this. If there is one, it lies in the heart of that. Whether we get there or not, it's going to be a function of what the Fed does and what the central banks do and how they deal with this. And there's many outcomes for that, and it is not going to be a straight battle. But all I do know is these things tend to accelerate much faster. I'm very cognizant of what happened in the UK with Woodford's fund and Neil Woodford's fund, and also with HTO Natexis. These are liquidity problems. And we've talked a lot on Real Vision about liquidity and the lack of liquidity in markets. And if you put in a bad event with low liquidity, you've got a problem. And I think we're starting to see alarm bells coming. So as I said, with phase 1, let's see what happens with phase 2. The end of it is the Fed are going to have to buy credit. They're going to have to stop this. They have to stop the doom loop. And the other thing they will do is underwrite the pension system. And this is part of the MMT and also part of the way that you get rid of the quantitative easing, giving money to the rich or the people who need it the least, the people who can borrow. And this way you give it to people who have a pension, and there also happen to be voters, huge numbers of baby boom voters you'll be bringing back into the system. So it's actually a very attractive thing for both the Federal Reserve and the government to push to do. So I think that's what comes of it. You're going to have to do something about this pension fund black hole, and this is probably the way to do it. You see, Europe and the UK dealt with a lot of this in the past because they started to put restrictions on what pension funds could do and the kind of risks that they could take. But they've still got a problem with credit for sure. And I think the Europeans will be involved in having to support their own pension system as well. So where does this all leave us? Well, that's what this week's going to be about. You can see how important this all is. And this is not just doom mongering. This is the reality of the probabilities. You cannot deny that the business cycle is weakening. You can deny that it's going into recession. But we need to find out more. We need to find out from other people. I really want to find out. I want to have that debate with people because I really want to know and assess the probabilities and figure out whether my probabilities are right. So I'm going to leave you with a few things. The things that really matter to me. I've given you a bunch of charts to look at that you can follow. I would use that Eurostoxx banking index as one very important chart. You can use maybe FedEx for world trade tariffs and stuff like that. FedEx looks pretty bad. But I think the primary chart is the chart of truth that I've always called it, which is the bond market, the 30-year channel, and how it perfectly kind of poked its head at the top of the channel and then reversed. It's telling us that bond yields are going to go probably down to zero. That's 10-year bond yields. If I show you the chart here of the long-term pattern of 2-year bond yields, it's very clear that they're going to go negative. And this chart suggests they're going to go to negative 2%. Now, for somebody in America, that might sound outrageous. To anybody else in the world, it's normal, right? Europe's had negative rates now for a long time, as have Japan. You know, all across the place we've seen negative rates. So get used to it. It's the mindset of what's coming. I don't think you're going to be able to avoid it because of the confluence of events that we've got coming with the excessive debt that massively built up over the short period of time, and then with the wave of retirees coming and the Fed having over-tightened. I think the dollar chart is extremely important. I think use the broad trade-weighted dollar index. It is a huge cup and handle formation as well, and if it breaks this 130 level, then we're going to see the final catastrophic large rise in the dollar that could break the rest of the system. I've been warning of this for some time. The dollar has been range bound. It keeps looking like it's going to break down, then suddenly break up and then break down. I don't know, but I do know it's going to break. And it'll be the last of the asset classes to make its move. If it breaks down, okay, we're going to give ourselves some breathing space. We're going to save emerging markets. We're going to save some of this debt situation for another day, and we'll extend what is the longest business cycle in all history. But if not, then we're going to start to accelerate all of these events. And a global recession with some really nasty outcomes is becoming more and more likely. And also the ADXY, the Asian dollar currency index, I think that's an important chart to keep on your screens, and maybe keep your focus on the EEM, the equity market, the emerging market ETF. These things are all within this basket of what we need to be looking at. And in the end, what do I think the trade is? My personal view, and again, I'm going to talk to other people about this, I think it is bonds. If I'm right and we're going to get worse, we may see a bounce in bonds now. I've just taken profits in a whole bunch of my bond positions, but I'm looking to aggressively add. Now, this is one of the biggest, highest conviction trades I've ever had. And I think that the bond market, particularly the short end, the Eurodollar futures and the 2-year futures, you need to leverage up and buy as much as you can of these into any bounce. I think we're hopefully getting a short bounce now, but I think once we get through and we start to see the economic data weakening once more, you won't be able to buy bonds. I think I'm really interested in buying dollars. I'd like them to break. Once they break higher, then I want to add all sorts of dollars. I don't want to short the equity market. It's too dangerous, it's too difficult, and I think it's a vanity trade versus the bond market trade. Obviously, I will get drawn into it again, but every time I try, I get my arse handed to me, so I'm going to try and avoid doing that one. The last two are pretty obvious. One is gold, because gold is an option on the end game. So if we are going to go to extreme monetary policy, which looks like I've walked you through a set of pretty easy probabilities that that could happen in the next 18 months, well then gold has to go higher. Now sure, if the dollar goes higher, gold's going to come back a bit, but over time I think the dollar and gold go higher, and gold goes a lot higher over the longer run. And it's now acting as that probability on this end game. And the final one is Bitcoin. Bitcoin is, again, a probability on the ability to build a different financial future. We're seeing noise coming out of China about building a cryptocurrency. We've seen the very interesting thing that Facebook's done. It's another thing that I will do for Real Vision at some point, is talk about that at more depth. Not that I think the Facebook cryptocurrency is the answer, but the globalized currency and what they were doing with the globalized currency, I think really is very interesting. It's something I talked about on Real Vision from the very beginning, maybe in the first ever interview. They were all talking towards coming towards this moment now. This is why we started Real Vision, and also this is why I do Global Macro Investor. We're in a very macro environment. It's super interesting, but it's also super dangerous. So me publishing Global Macro Investor, I thought I had to get this across to you so everybody understands the risk ahead and can do their own work on it. So I'm really looking forward to taking you with me on this journey. There's going to be a lot of learning. There's going to be a lot of debate. And I'm going to bring different angles. I'm going to bring people from the oil market, the retail market, the car market, the VC market. I'm going to bring macro experts, Bitcoin experts, gold experts. I'm going to bring everybody to the table. And we're going to talk it all out and figure out, okay, what the hell is going on and what the real probabilities are. Guess what? We're doing a sweepstake. you can get a chance to win a premium subscription to Real Vision. But we're not just giving away 1, but 10 subscriptions. All you have to do is subscribe to our Real Vision YouTube channel, like this video and comment down below. On August 31st, we'll contact the 10 winners. So subscribe now for your chance to gain access to our critical series on recession, as well as other series on tap about gold, retirement crisis, and many of the aspects of economic and investing life that will affect you and your savings.